In simple words, accounting could be defined as the process of recording, summarizing, analyzing, and reporting financial information pertaining to any business. Although it seems like the brainchild of contemporary financial setting, the earliest attempts of accounting date back to the ancient civilizations. And this very fact highlights the importance and involvement of accounting in human life across centuries. Moreover, the significance or importance of accounting is not just limited to the technicalities of running a business. Its essence permeates through our day to day lives and composes of a variety of ordinary activities like filling your income tax returns or monitoring various transactions. Since these tasks could prove to be quite laborious more often than not, I am here to help you beat the struggle by introducing you to some basic terms used in accounting, particulars related to financial statements like the balance sheet, the income statement, or the cash flow statement. So just sit back and watch your ordinary accounting troubles fade away. If you haven't subscribed to our channel yet, we request you to hit the subscribe button and turn on the notification bell. This is done to make sure you don't miss out on any of the new updates or video releases of great learning. And of course, if you enjoy this video, show us some love, do like the video. Knowledge increases by sharing, so make sure you share this video to your friends, family, and whoever can make use of it. And at the end of it, make sure to comment on this video if you have any queries and suggestions, and I would be more than happy to respond to all of your comments. Before moving on, let's talk about our learning objectives. So we'll be starting with knowing what is financial accounting, what is the need of financial accounting. Then we'll know about the three main financial statements called the balance sheet, income statement, and cash flow statement. So we'll be discussing in depth what are the various components of it and what are the uses of all three statements. At the end, we'll be discussing about the various financial ratios that we look at when we analyze different companies and their performance, how well they are doing, how stable they are, what are their growth perspectives. So we'll look at that in the module of financial ratios. What is financial accounting? So as the name suggests, financial accounting is something that is related to finance or money, right? So it is basically the recording, summarizing, and analyzing of various business transactions that are happening in a company on a day-to-day basis. So all these business transactions are then noted down and used to create three major documents called the balance sheet, income statement, and cash flow statement, togetherly known as the financial statements. Now, these financial statements are utilized by both the internal stakeholders and external stakeholders of the company. Internal stakeholders would include the top management of the company, and external stakeholders would include the retail investors or the common people who would wish to invest in the company through stock markets. Now, these statements would provide an accurate view of the financial health of the company, whether the company is in profit or is in loss, whether the company has accumulated too much debt and liabilities in its side, or does it have surplus amounts that it would give out as dividends. So all these things have to be documented in these financial statements. Before talking about these financial statements in depth, let's talk about basic terms and terminologies that are used in the accounting world. So there are mainly five types of accounting terminologies, one being asset, liability, revenue, equity, and expenses. So let's look at what is an asset. Now, asset is a resource that drive future economic benefit to a company or an organization. So it consists of cash, office equipments, machinery, land, property, and investments. It can be a short term investment or a long term investment. All of it comes under asset because it drives certain value for the company in the coming years forward. So not all assets are visible to us. There are some which are intangible, like patents, intellectual property rights, trademarks, etc. Some of them are tangible, like cash, land, property, machinery, etc. Next is liability. Liabilities would be of two types basically. Short term liability would include short term debts. Long term liability would include long term mortgages, long term bank loans, etc. Next comes equity. Equity is the amount of capital that is owned by the promoter of the company. It tells us about the ownership of a company or a business entity. What you see is known as an accounting equation. It is known as equity equal to assets minus liability, or in the other terms, asset equal to liabilities plus equity. Okay, so let me show this with an example. Let's say that you are buying a truck for your company for your logisticals needs. You're buying a truck worth 1 crore. Okay, but you only have 20 lakh in hand with you, and the rest 80 lakh you take a bank loan, right? So in this case, that the 20 lakhs that you have in your hand is called your equity, and the 80 lakh that the loan that you have taken is called liability, because you have to give it back, right? And the 1 crore that you have is called an asset, because it would drive a future economic benefit when you use this truck in the logistical needs or to get raw materials or to deliver products. This would drive a economic value in the future, right? So this is asset. Now if you subtract equity equal to asset minus liability, if you subtract the assets of 1 crore minus 80 lakh, you would get 20 lakh as equity, right? So this right here is also called as the accounting equation, right? Which is very important to know. Next is revenue. Revenue is the amount that is generated by the company from its core operations by selling a product or a service in a given period of time. So the point to be noted here is that revenue is not the profit or a loss of a company. Revenue is the selling price of a particular service or a product. Let's say that you are selling samosas of 20 rupees each. So that 20 rupee that you are selling would be your revenue, because we haven't subtracted any cost that is incurred from it. So it is the total amount. Next is expense. Expense is the cost that is incurred in the development of a particular product or a service. Now, expense would not have any future benefits, right? Now, if we subtract an expense from the revenue, we get net income. Net income is basically if the product is in profit or loss. Let's take an example. Let's say that you are selling tea that is of 10 rupees. Now, this 10 rupees is your revenue, as this is your selling price, right? Now, making of tea, the cost would be milk, let's say of 2 rupees, sugar, 1 rupee, and tea leaves, that would be of 2 rupees again. So the total making cost would be 5 rupees, right? So this part would be your expense for making that particular product. Now, if you subtract these two, subtracting 5 from 10, you would get 5 rupees. That is your net income. So it is profit, since the expense is less than the revenue, you get profit. If the expense is greater than the revenue, then you would have a loss. If the expense is less than the revenue, then you would have a profit, right? Next, we'll be talking about the two methods of recording transactions, that is accrual based of accounting or cash based accounting. Now we'll know the difference between the two coming forward. So first we'll start with cash accounting. So cash accounting is a method of recording transactions in which the entries are made only when the cash has exchanged hands between two parties. So the revenue is entered and the expense is noted only and only when the cash has been received or paid out. So let's say that you are purchasing a raw materials for your business. So the day on which you give out the payments as cash will be recorded in the expense account. Secondly, when you make the sale of those products, on the day you receive that cash from the particular customer, then the entry will be made in the revenue account. Okay, let's take an example. Let's say that you are a retail phone seller. So for that, you would need to first purchase the phone from the company and then sell it to the seller, right? So first step would be to purchase the phone from the company. Let's say you paid 15,000 rupees. Okay. to get that phone on 20th, let's say December. Okay. Then you would sell that particular phone for 20,000 rupees on, let's say, 29th of December. Okay. And the cash you will receive of that particular phone, let's say 2-3 days later on 1st Jan. Okay. 1st Jan is when you receive the cash. Okay. Now, what cash based accounting states that you will make the entries only on the day you have either paid out the cash or received the cash. In the case of expense of 15,000 that you purchased from the company, you will make the entry on 20th December because you have paid out cash on that particular day. After selling that particular phone for 20,000, you will make that entry on 1st January and not 29th December because you have received the cash on 1st January. Now you have to look at the December account. So in December account, you have paid the money to a company, right? To the phone manufacturing company. So that will show me a loss of 15,000 as the money has went out of you. Similarly, in case of January account, since the entry is made in January, so in January account, it would show me a profit of 20,000. Now, this is not a correct picture of a financial health of a company as in two different months in a particular time in history. So it is giving me an unrealistic example of how things are going. Now we'll know the disadvantages of cash accounting. As mentioned before, that it is not accurate to identify the financial position of a particular company in a given period of time. Second, it is not recognized by both GAAP and IFRS. Now, what is GAAP? GAAP is General Accepted Accounting Principles. So, second is IFRS. It is International Financial Reporting Standards. So, both of them discourage the use of cash accounting because it does not give a very good picture of how the company is doing. So no big company uses it. So if you have a very small business like selling of tea or selling of samosas, then this would work out, but not on the scale in which you have lot of products and service to be delivered in the coming months that would have a deferred revenue. Next comes, there are a lot of loopholes since it is a very vague standard in which you will only account it when something is received or when something is gone out. So it would involve a lot of unfair practices, which is why it is discouraged. Next up is accrual accounting. So in accrual based of recording transactions, what exactly happens is the revenue is noted down when it is earned and the expense is noted down when the expense has incurred. What does that mean? So for example, that you are selling a bulk order of 35 of particular product. So on the day of that particular order, you will be writing it down in your revenues account on that time. The payment of the clients can come later, that's not an issue, but on the day in which the order has been placed, on that day it will be marked in your revenue account. Similarly, when you buy your raw materials, so on the day when you have made that purchase of the raw materials, on that day it will be marked in the expense account. So the bills of those raw materials can be paid later. So in the previous example, what we noticed in cash accounting was that on 20th December, when you purchased the phone from the manufacturing company and you sold it on 29th December with the payment by the customer being done on 1st January. So 1st January was noted down, right? But in this case, in accrual type of accounting, the entry into the revenue part would be done on 29th December itself. So what would happen is in the December account, there would be an expense of 15,000 on 20th December and there will be a revenue of 20,000 on 29th December. So this is the difference between the two, cash accounting and accrual accounting. Now in this case, if you would know what is the profit that you would earn, that is revenue minus expense. So revenue, if I subtract expense from revenue, it will be 5,000 rupees. So this would be the profit in December account. Now this would give a good and accurate picture of how the company is going in that particular month, right? So that is why accrual based accounting is preferred over cash based accounting. We'll look at some of the advantages of accrual accounting. So in this case, first, it gives a very good picture of how the financial situation or financial health of the company is. Secondly, it works on all the standard principles like Financial Accounting Standards Board and GAAP, generally accepted accounting principle. Both of them recognize accrual accounting as the basis in which the company should record their transactions. Thirdly, it shows exact amount of profit and loss that is beared by the company. So it gives you an accurate picture of that. Next, we'll be talking about one of the three financial statements. So we'll start with balance sheet. We'll know the various components of a balance sheet, and also we'll have a sample balance sheet that I'll show you to have a deeper understanding of what balance sheet exactly is. So balance sheet contains the information about three primary objectives. That is, it tells us about the asset part of it. Asset means the future economic benefit that it would give. Second, it tells us about the liability section of it. Now, liabilities are what are the borrowings of the company, what it is liable to pay outside the organization, right? Thirdly, it tells us about the ownership of the company, the equity part of it. Okay, so the four major headers in a balance sheet that you will find are these things called current assets, current liabilities, non-current asset, non-current liabilities, and also the equity part. You will find it. Okay. So first we'll talk about current assets. Now, current assets are something that the company can convert into cash within a year. So these are also current assets are also known as short-term assets because it is readily available within a year. Okay. So now balance sheet typically tells us its ability to repay any debts that it may have, right? So it just gives you a glance of it, how the company is doing, how much assets they have, how much liabilities they owe to someone, and what is the owner's equity in it. Okay. So the examples of current assets would be its short-term investments, that would be a very short-term based, short-term mutual fund, short-term anything that would be converted into cash within a year. That would be a short term investment. Second would be marketable securities. Now, this would be a purchase of governmental things like government bonds, corporate bonds that can be cashed out within a year. Next would be amount receivable. Now, this would be like the company has given out loans to other organizations or other business entities that would be repaid within a year with an interest on it. Okay. So this would also come under the current asset. Then it would be the in hand cash that the company would already have in its bank account, which it can use immediately during an emergency or during any other event. It has readily available. Next is the inventories that it possesses. So it can have a lot of work in progress inventories that are currently in use or being used in the coming months. So that would also come under current assets. So this was about current assets. Now we talk about current liabilities. Now these are the obligations that the company are due to pay someone within a year of operation. So in an year, what the company is liable to pay comes under current liabilities. So it would be accounts payable, short-term loans that it has taken from banks that it needs to repay within a year. The dividend. So if the company is very profitable, so that profit amount it would share it with its stakeholders, internal stakeholders or general public or the people who have bought its shares. So it would give out to them. So that would be dividends payable. Then it would be notes payable. Now the examples would include first accounts payable. Now accounts payable is an amount that is owed to a supplier of a company, of a primary supplier or vendor that it owes, right? That it needs to repay within a year. That would come under accounts payable. Second is dividends payable. Dividends is if the company is very profitable and it has an extra money that it wants to give back to its shareholders or the ones who have bought its share. So that would come under dividends payable. So this happens either quarterly or once in a year, so that it needs to pay out, or it can reinvest in its own company, but this is an extra amount that it gives out. Third is notes payable. Now this is the amount that it owes to a bank if the company has taken a short term loan that it needs to pay back, or to a financial institution, that comes under notes payable. Then comes accrual liabilities. Now these are short-term liabilities that the company has incurred. So it would be the interest on loans that it needs to pay back. It can be the tax that is liable to pay to the government, or it can be the salaries or the wages of employees that needs to be paid within 1 year. So these all things would come under current liabilities or short-term liabilities. Next would be non-current assets. Now non-current assets are also called as long-term assets or long-term investments that the company has made that is more than one accounting period, right? That would include the investment in government bonds, corporate bonds, mutual fund and real estate that are in perspective of long term arrangements. Okay, so these are not short terms. They would not withdraw the money in 1 year. It would probably be for like more than 1 year, for 5 years or 10 years, that the company thinks that this investment that they are making would give them hefty returns in the end. Second would be, now there comes two things in asset. One comes the tangible assets that you can physically touch, feel, experience it, right? So that would be property, plant, and equipments that you can physically see and that you would make use of it in the foreseeing future. Second would be intangible assets that you cannot touch with your hand or see it with your naked eye, but that exists. That would be patents, trademarks, intellectual property rights, and copyrights. So these would come under intangible assets. As non-current assets are, they are also long-term assets of the company. Next comes is non-current liabilities. Now these are also similarly, non-current means long-term, which are not due within 1 year. So all these bonds payable, long-term loans, deferred tax liabilities, long-term lease. So some of the times what happens is that a company takes a place for rent for like 5 years or 6 years in total. So the rents that needs to be paid out may be paid later depending on how the company's current situation is. So that would be a long-term lease that it would have to pay. Then it would be the deferred tax that it needs to pay to the government or regulatory bodies. Then it would be the long-term loans that it has taken for over a 20-year period or a 10-year period, something like that. Next is bonds payable. Now what happens is sometimes the company would ask loans from the banks that would be too huge for a bank to give out. So in that case, what happens is companies issue bonds to normal public or normal shareholders in which they guarantee a nominal interest rate on that particular amount. So for example, if someone is willing to buy the company's bond of let's say 50,000 rupees with a 7% interest, so this person would give the company 50,000 rupees, and in return they would give them a bond certificate stating that the company would be liable to pay him 50,000 rupees with 7% interest. Okay, so that interest part of it that needs to be paid is called bonds payable. Next, now we look at a sample balance sheet and know what are the components where they fit in. And to know where do you find all these financial statements, so if you go to the company's website, any company, it can be Tata, Mahindra, Reliance, Adani, anyone you can pick, you can go to their official website. So in that you'll scroll down, at the end of the page there will be a column called as investor relations. You click on that, then there will be options of reports. So in that there will be an annual report. So that is a very huge book. So it is a PDF of around 1000 pages. So in between of that, you will find all these financial statements there. So I'll show you how it looks like. So this is how a balance sheet totally looks like. Now it has three main columns. The first one is the header part of it, which tells us where the amount is received or going. Second is the note sections. So everything cannot be fit into this particular sheet. So there are some headers that has notes involved. So in the annual report, you can find the detailed description of each header there where the money is and everything. So you'll find that in the note section here. So the next column would be this year's financial status of the company in 2021. So this is a 2020-2021 financial report. So the in India, financial accounting period starts from 1st April to 31st March. So every year 31st March is when this balance sheet comes out. So it gives us of a previous accounting cycle also, just to compare how the company has done in the previous accounting period. So this is how it gives an overview of it. Okay, so the first section is always the asset section of the balance sheet. So the first section is always the asset section of balance sheet. So you'll find assets on the top. So it is divided into two parts, non-current and current. We already discussed what that is. So as mentioned, we have property PPE, property plant equipment, other intangible assets, financial asset, loans it has given out, investments and other things mentioned over here, right? This is the non-current asset part of it. The current asset would be other trade receivables. This is the short-term ones. This is the long-term ones. Okay. So the total of these two, 1 and 2, the total of 1 and 2 would be mentioned over here. So this is the total assets. So the second part that comes is, so it has equity, share capital and other equity. The total of that is also mentioned here, 45,504 lakh rupees. Then comes the liability section of it. So liability is also divided into non-current and current liability. So that would be trade payables that we discussed, financial liabilities. So it has, depending on industry to industry, there are a lot of different types of headers. Okay, for an automobile industry, it would be different. For an airline industry, it would be different. For a petrochemical industry, it would be different. Or similarly, as garment industry, it would be different. So the headers would depend on sector to sector in which the company deals with. So now the subtotal of current liability is mentioned here, of non-current is mentioned here. Now we have previously discussed our accounting equation, which states that assets equal to liabilities plus equity. So the asset part of it, that is total assets 59,013 lakh rupees, should be equal to total liabilities plus equity. So this balance sheet has already done it for us. So total equity and liability, as we can see, is 59,013, which matches the total assets, which says that the balance sheet is already balanced and it is accurate. So the next financial statement that we are going to discuss is called the income statement. Now the income statement tells us about the revenues, expenses and the tax incurred by a company in a particular period of time, maybe a quarter or annually. Okay, so this is also known as profit and loss statement. So in a nutshell, it tells us about the profitability of a company. Okay, the main headers: revenue, expenses and EBITDA. From these three headers, we calculate a number of things like gross profit or net income or operating income. All these things are calculated using these three headers. So what is this EBITDA? Revenues we have discussed before, expenses also we have discussed before, but what is this EBITDA? EBITDA means earnings before interest, taxation, depreciation and amortization. So interest would be, I would be interest. So interest would be if the company has taken loans or something like that. So how much interest it to pay to the bank or from wherever the loan has been taken. Second is the taxes. So what are the taxes it has to give to the government, or the road tax that would be involved in logistical supplies. So all that thing comes under taxations. Then comes depreciation. So for example, if a company takes a truck and it is going to use for let's say 50 lakhs, and let's say that it is going to use it for the next 10 years. So after that, on the 10th year, let's say its value is only 10 lakhs. Okay, so in that 10 years, it has lost 40 lakhs of value, which is called as a depreciation. So the value that has decreased by the use of that asset is called depreciation. Next is amortization. Now, amortization means that paying off your debt in a regular repayments over a course of time, fixed repayments over a course of time, payments are called as amortization. Okay, so this thing would be in EBITDA. Now, income statements can be a lot more complex than it seems. So to understand it more easily, so I've broken down the income statement into several steps to make you understand more comfortably. So the first part of an income statement is, the first header is the revenue or the sales, right? So the total revenue that has been generated by the company through its operations by selling of particular goods or service that the company is dealing with, and also the interest that it has gained by several investments or any other things that it might have gained money from. So that would be a total revenue. Now if you subtract COGS, what is this COGS? This is the cost of goods sold. So if you're making a particular thing, like if you're an automobile company, you're making cars. So what is the cost that you have incurred while building that particular car is called the cost of goods sold. So if you subtract that from revenue, you would get a term called gross profit. It would have a lot of different expenses involved, like let's say financial cost, employee cost, transport, logistic cost, etc. So all these things would come under operating expenses. Okay, so from that gross profit, if we subtract operating expenses from gross profit, we'll get EBITDA, that is earnings before interest, tax, depreciation or amortization. Now in some instances, there would be certain companies that would attach their depreciation and amortization in operating expenses. Okay, this would be technology companies, because technology companies do not have much of the products that have a depreciating value or amortization in general. Let's say that a technology company has several softwares, so it would not have a very big depreciation over the years, so they consider it under operating expenses. But other companies like oil, petrochemical, automobile companies, they have huge machinery which gets depreciated over the times, so that would be another section in income statement. But most of the technology companies keep it inside the operating expenses. Okay, so after subtracting this, you will get EBITDA. Now in EBITDA, if you subtract the depreciation and amortization value, you will get EBIT, earnings before interest and taxation. Okay. From that, you subtract the interest part of it, then you will get your first thing, earnings before tax. Okay. So this is a major component when it comes to knowing how the company is performing, because tax would be almost the same over the years depending on the revenue and other factors, also government policies and everything. But main purpose to analyze a income statement would be earnings before tax, because it would give you a clear picture how the company is performing. If you subtract the tax part of it, then you will have your net income. Now this will tell us if the company is profitable or not. So this can be either profit or loss. Okay, so this was the major components, breakdown of components of an income statement. Now let's look at an actual income statement of a company. So this is how it looks. It looks similar to a balance sheet, but has different particulars involved. So it has main sections as revenue, expenses, and taxes, right? So similar to balance sheet, this also has three major sections. One is the current year in which the values are given for. The other is previous year to compare how much performance it has gained or lost over one financial year. Then would be the note sections. This would be an elaborate picture of what are the different particulars here. Elaborate picture would be in the note section. Okay, so let's see it. First is the revenue of operations, and the other income would be their investments or something like that, in which they have gained good amount of interest. Then revenue from operations is their core thing in which the company is standing there. So this is their USP, the way in which they make money. Okay, second part comes the expenses. Now this would include employee expenses, various financial costs, depreciation, and other expenses. So just as I said, some of the companies include depreciation and amortization in their expense part of it. So this company has done the same. So we can see, get the values of it. Now we get the total expense. After adding all these things, we get the total expense. That is 22,457 lakh rupees. So I would stress on this other expenses. Now everything cannot be put in an income statement. So you will find these other small minute expenses in the note sections. Okay, so 19th would be the note in the annual report where you would find this. Now we can see they have given us a good picture of profit or loss before their taxation. So this is earnings before tax. So if we subtract the revenue, total revenue, that is 26,855, to the total expenses, that is 22,457, we'll get earnings before tax of 4,398. Okay, so this part is earnings before tax, and we subtract other tax expenditures from it, then we'll get a net profit or loss, which they have calculated as 3,202 lakh rupees. So this is our net income. Okay, there can be several other things like mentioned over here, which depends on company to company and sector to sector. Okay, so we'll not go in depth on that note, but this would be your net profitability of the company. Okay, so how to differentiate between loss and profit in income statement? So as in this case, they have given loss in bracket. So anything that you see in bracket would be a negative value. Okay, so some companies directly give a negative value over here. Some of them give it in bracket. So it varies from company to company. Okay, so last section we see here is something called as earnings per equity share. Okay, so what does that mean? So this is called a financial ratio that we look for a particular company to compare it with other companies and to see the trends over the past years, how it is doing. So this we will know in a last module. We'll know it in detail what EPS means, earnings per share. So this was all about income statement. So the financial statement is called the cash flow statement. Now, cash flow statement tells us about the cash inflows and outflows from the company. So it gives us an idea how much cash does the company possess in hand at a particular time. So the main components of the cash flow statement, or the main headers in a cash flow statement, are three of them. The first one is cash flow from operational activities. The second is cash flow from investment activities. And the third is cash flow from financial activities. Now let's look at what does cash flow from operational activities mean. So cash flow from operational activities tells us about the cash that is spent or earned in the operations of that particular firm or business entity. So these particular operations are the core of what the company stands for. So its main product or service, how much cost that has been incurred, how much revenue it has gained. So it tells us about that. So this includes, as mentioned, revenue, working capital, how much amount is needed for its day-to-day operations. Then it's expenses. Now expenses would be rent, it would be the wages that it needs to pay to its employees, it would be electricity bills, and so on. So cash flow from operations is the addition of net income, the working capital changes, and non-cash components. Okay. Next is cash flow from investing activities. Now this would be the amount that is spent on other investments like mutual funds, land, property, equipment, acquisition and mergers with different businesses, and also investments in marketable securities, that would be corporate bonds or government bonds, something like that. Next would be the cash flow from financing activities. Now, this would include raising and deploying for various financial activities like issuance and repayment of any debt or loans, as mentioned. Then it would be the payment of dividends, lease payments, issuance of equity. So, the major chunk of cash flow from financial activities for any business is generally either the repayment of loans or the repayment of debt or dividends. Okay, that constitutes the major chunk of portions in financing activities. Now let's look at a cash flow statement of a company. So as mentioned before, that it has primarily three types of cash flows. First is the A part, that is cash flow from operating activities. Now we have seen it in the income statement, that profit before tax. So it is the same value. Let's check. So in the income statement, we had this profit before tax from operations, that was 59,387. Okay, so here we see that is the same amount in cash flow that has been carried forward from the income statement, 59,387. Now there are certain adjustments that are made. Now these adjustments, as you can see from here to here, all this would vary from company to company, sector to sector, it would vary. So now we won't get into this what it is, because it would have been different for an airline industry, for an FMCG company, for a motor company, and all these things would be different. So there are certain adjustments that need to be made, certain property, land, recoveries, logistics, losses or incomes that should have to be adjusted for. So that is mentioned in this section. So after adjusting, we have a net profit of 63,548. After that, the working capital that is required for the company, it also has certain adjustments in their inventories, trade practices, and all this financial assets. So these things are also adjusted. It can be plus or minus. So increase is mentioned in brackets. This is minus, decrease, plus, 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 plus. This is minus. After this, we'll get a net amount of 61,759. Now, this is the cash that is generated from these operational activities. Now, they would incur certain taxes on it. So after subtracting the taxes, we will get a net amount of 47,405. So this was part A. So now the second part is the cash flow from investing activities. Now I already mentioned you what it is. So it is the loans that are released, the interest release, the payment, acquisition of land, property, and sale of any equipment if there is any. So these things are also added, subtracted in the way it is. Now total net cash from investing is this 7,472. So we'll add 7,472 to it. Now, cash flow from financing activities is most of the times in negative, because these are the things that are rolled outside of the company, like dividends are paid to the company, the interest on the loans is paid back to the banks. So in this case, all these things would be subtracted. So the net cash in financing activities would be negative. Okay, these all would be negative. interest on liabilities, interest paid on lease, principal payment of liability, dividend and dividend tax paid. So all this is negative. So we have a negative figure. It's in brackets of 19,063. Now what should be in brackets and what not? That would depend. It would have some of the values could be positive and negative. You have to actually see which one is positive, which one is negative. So in this case, this financing activities is negative. So I'll add both of the A and B. From operation investing I'll add, and financing I'll subtract 19063. Now I will get the net value that is mentioned over here, 35,814. Now what happens in this case is that it is rolled. There is a cash and cash equivalent at the beginning of every year. So that is basically the end of previous year's cash flow statements last entry, that is cash equivalent. So as you can see here in 29, year ended in 2019, you had a cash equivalent of 52,590 lakh rupees. So this added with this year's cash equivalent, so this value here is posted here because the end of previous year's cash flow entry would be this year's beginning cash flow entry. Okay, so this added with the net increase in cash flow would give us the equivalent for this year's end, 2020's end, and it would be marked as 2021's beginning. Okay, so these are the three things in cash flow statement that needs to be known: cash flow from operation, investing, and financing. So as common citizens, as retail investors, we would also like to put our hard-earned money into some of the best companies so that it can grow in the stock market. Okay, so in order to do that, we look at these financial statements that we discussed before, and apart from it, we also look at some of the financial ratios that are derived indirectly or directly from the financial statement itself. So let's to get a very good view on the performance of a particular company. So let's look at our first financial ratio called earnings per share. So earnings per share is the distribution of company's profit to the outstanding shares it has allotted. Okay, so it tells us about the earnings of the company per share. So how it is calculated? So we got the net income from the income statement that we got and the dividends that the company has given in a particular period, divided by the total number of shares that it has allotted. Okay, that is out in the market. Let's take an example. So example would be, let's say the company's net income, XYZ company's net income is 22 lakhs 15,000 rupees, and it has allotted 15,000 as dividend. Okay, and let's assume the total number of common shares would be 20,000. So if we calculate it, it would be 2 lakhs over 20,000. So that comes out to be, EPS comes out to be 10 rupees. Now what does it mean? So let's say that you as an investor has bought 200 shares of the company at, let's say, 500 rupees price. Okay, so if I multiply this 200 rupees with the EPS, it would give me 2000 rupees. Now this 2000 rupees is the company's earnings that has got because of you, that you have invested the money in. So now this 2000, what the company can do is it can give back to you as dividends, or it can put the money into its own company for its growth purposes. Okay, so when the company puts its money in the growth purposes, it is bound that the share of that particular company would go up because it's investing in itself to for a better future. So the share price will go up, hence the value of your shares will also grow up. So this is what EPS means. Next is, so now the PE ratio tells us about the profits to the earnings of a particular company. So it is basically how many times more I'm ready to pay for a particular stock than its earnings. So let me give you the same example that we had before. So in that case, our price per share was 500 rupees and our earnings per share was 10 rupees, right? So our PE ratio is 50. So basically, I am willing to pay 50 times more than its earnings. So now what is this value? So this P ratio tells us about, is the company overvalued or undervalued? A very large P ratio would mean that the company is overvalued. So it is probably the time in which you do not want to invest in such a company. While on the other side, if the P ratio is very less, I mean in single digits or very less, then it means that the company is undervalued and it is a good time to open your position in these companies, start investing in these companies. This is generally what it means in a broader perspective, but again, it would vary from sector to sector, company to company. So this value, we can actually compare it with its peers. Okay, the peers would be different companies which are operating in the same spec sector. So we can compare different auto companies, different petrochemical companies. So you would have the choice to look at its PE ratio and choose which one would you like to invest in. Okay, so this is what PE ratio means. The next financial ratio is called return on equity. Now, return on equity tells us about how much money the company is making on its shareholders' equity. So basically, it tells us about how efficient is the company in making profits. Okay, so it is calculated by dividing the average shareholders' equity to the net income. Now, net income you will find it in the income statement, and average shareholders' equity you will find it in balance sheet. Okay, you'll find shareholders equity. How do we calculate average? So for a financial year, so you'll take an average of the first month and the last month, you will get average shareholders equity. Now let's take an example. Let's say a company is having a net profit of around 150 crores, let's say, and its average shareholders equity is around 700 crores. Now the return on equity would be around 0.21. So it would be around 21%. Now this is your ROE. Now for any company, in general saying it is that the ROE should be more than 15 to 16% is considered good. Okay. Below this is considered on the weaker side, but above this is good. But there is a catch. So return on equity is not the primary financial ratio to look at. It can be misleading at times. For example, if the company has taken debt too much loans, then this ratio would become greater, which would lead to biased results, which would not be accurate in our analysis. Okay. So looking at ROE, first you need to look at its financials in detail. Does the company has a lot of borrowings or something like that? You need to check before analyzing purely on the basis of ROE. Next financial ratio is debt to equity ratio. So this tells us about the borrowings of a particular company. So how much the company is in debt per 1 rupee of shareholders equity. So the ratio can be calculated by dividing the total liabilities of the company. So debt to equity ratio can be calculated by dividing the total shareholders equity to the total liabilities of a company. Both the things you will find in the balance sheet, liabilities as well as shareholders equity. So on dividing it, you will get the debt to equity ratio. Now, if the debt to equity ratio is too high, it means that the company is in financial trouble. Okay, so it is not making enough revenue even to run its operations. So this can be a very risk factor if you are willing to invest in such a company with high debt to equity ratio. Let's recollect what we have learned so far. So we started by knowing different financial accounting terms and terminologies. We got to know about the difference between cash based or accrual based accounting. Then we had a detailed analysis of what is a balance sheet, what are the various components of balance sheet. Then we moved on to income statement, had a look at how the income statement looks like, what are the basic steps involved in calculation of certain things like EBITDA, net income, gross profit, etc. Then we had an in-depth view of what cash flow statement is, what are different headings and components of a cash flow statement. Then we got to know about the different financial ratios that help us in recognizing a good company and a bad company in their performance, right? So that was in financial ratios. Hope this course was really useful and helpful for you to gain good insights in the financial world. Thank you all. If you haven't subscribed to our channel yet, we request you to hit the subscribe button and turn on the notification bell. This is done to make sure you don't miss out on any of the new updates or video releases of great learning. And of course, if you enjoy this video, show us some love. Do like the video. Knowledge increases by sharing, so make sure you share this video to your friends, family, and whoever can make use of it. And at the end of it, make sure to comment on this video if you have any queries and suggestions, and I would be more than happy to respond to all of your comments.